Homeownership isn't always the smarter financial move, even with mortgage rates finally dropping. Let me break down the real math behind the rent versus buy decision that most experts get completely wrong. When mortgage rates were at 3%, buying made sense almost everywhere. Now at 6 to 7%, it's a different game. Here's what you need to calculate. Take your potential mortgage payment plus property taxes, insurance, and maintenance costs. Compare that total to your current rent. In many major cities, you're still paying $500 to $1,000 more monthly to own the same quality home you could rent. The hidden factor most people miss is opportunity cost. That extra money you're spending on homeownership could be invested elsewhere. At 10% average stock market returns, that $500 monthly difference becomes $115,000 after 10 years. But wait, what about building equity? True, but remember, you only build significant equity in later years of your mortgage. Early on, you're mostly paying interest. Location makes all the difference. In the Midwest, where homes are $250,000, buying often wins. In coastal cities with $800,000 starter homes, renting frequently comes out ahead financially. The intangible benefits matter too. Owning gives you control and stability. Renting offers flexibility and fewer maintenance headaches. Don't fall for the renting is throwing money away myth. Run your own numbers using a rent versus buy calculator. Sometimes the smartest financial move is to rent and invest the difference until mortgage rates drop further or your income increases.